Hello everyone and welcome to the monthly market update. I'm John Cunnison, I'm the Chief Investment Officer at Baker Boyer Bank. And today I'd like to share with all of you a simple observation about how we all process the world around us. Now, when times are uncertain or complex, we tend to rely on narratives. We simplify. And this is particularly useful because it helps us to make decisions without having full information or perfect information. Now, it also carries with it risks, right? We're good at telling ourselves these narratives, these stories about the world around us, and they can be very compelling. But often they can be unreliable. And this is particularly true of pessimistic narratives. Pessimistic narratives can sound particularly thoughtful or insightful, and that's particularly true if they align with the worries that we already have about the world or the concerns that we have. Now, it's easy, especially in moments like this, to believe that the times that we're living through are uniquely difficult, or that the outcome is, unusually uncertain. But if we look to history, we see that investors in many times in the past have lived through and invested through times that were objectively more severe than what we're living through today. If we simply look back to the early 1980s, there was double-digit employment, double-digit inflation, and a deep recession. Now, of that time period, a famous investor named Peter Lynch, he wrote that serious professionals at the time were talking about taking up hunting and fishing and gathering acorns because things were so severe in the economy. He said that when things got the most severe, there was talk, 8 out of 10 of them talked about going back to the 1930s. And yet, what did the market do? It returned with a vengeance, and all was right with the world. And that's the way things usually play out. Now, the point of this is not to say that these concerns aren't real. They are. The point is that as investors, we need to be aware that these compelling narratives are just that, very compelling, and we need to make sure that they don't overly influence our long-term investment decisions. Now, as you all know, in addition to these monthly market updates, we host in-person economic updates in all the markets we serve, so Walla Walla, Yakima, and the Tri-Cities. Now, we just finished those 3 presentations in all of those markets this week, and they're very well received. The 2 presenters and the 2 presentations were done by Stuart Gillen, so our newest portfolio manager based in Tri-Cities, and Tyson Romanek, our senior portfolio manager here in Walla Walla. And the 2 presentations really focused on these narratives that are on the minds of all investors today and help provide context and nuance around those stories to, in a sense, particularly the pessimistic narratives, to kind of rob them of their power and allow us to make those very prudent, thoughtful, long-term investing decisions. Now, the most common reaction or thought that I hear about today's market and economy is, how can the stock market be hitting record highs? And we're just above 7,300 on the S&P 500. How can we be hitting a record high in the stock market just as we are encountering one of the worst energy shocks in a generation as a result of the war in Iran? Now, if 5 or 10 years ago I would have told you that there was going to be a blockade of the Strait of Hormuz and a very pronounced energy shock, your reaction would have been the world will be in a recession. And yet we're not. So the economic growth in the United States in the first quarter of this year was 2%. So the economy is, by the numbers, quite healthy. And that really speaks to the power of the investment boom that's happening with AI right now, the power and the scale that's being funded, by the way, by very well-funded, profitable companies. So there's currently a tug of war in the minds of many investors. Should I, in my portfolio, prepare for a world of higher inflation driven by potential escalation in the Iran war and the potential for higher energy prices for a long time? Should I prepare for a recession, given what that energy shock could do to economies around the world and companies that rely on oil and gas as inputs, which is many of them? Or should I be preparing my portfolio for an economic boom? Right? That's a result of the efficiencies, the companies that are using AI as AI diffuses into the economy. They're using AI to do things better, faster, cheaper. The innovations that will come in biotech and energy and other fundamental science endeavors through the use of AI. And the innovations that will come from investments that are made in things that the AI infrastructure build-out needs, such as energy, a revitalized nuclear industry, for example. Which future should we be preparing for in our portfolios? And the answer is, because we cannot predict with any certainty, we need to prepare. That means we're building diversified portfolios. And there's a lot to be excited about in all the major asset classes that we use to build a diversified portfolio. In the US, there's companies that are the recipients of all of this AI spending. They tend to be more old economy names. Oil and gas, for example. Walmart using AI to be, deliver products better, faster, cheaper. In the international stock market, particularly in the emerging markets, we see an exciting story of both old economy and new economy. Right? In Taiwan, we have TSMC, right? One of the largest chip manufacturers in the world. The Taiwan stock market was up a tremendous amount. South Korea up even more based on Samsung, right? It was a major economy there. Now you're only going to get exposure to those two companies in an international portfolio. And this is a point that Tyson made very clearly in our economic updates. So international exposure is going to be very important. And for those who have been following us for a long time, we have long advocated for a meaningful position to international stocks. And for people who followed that advice, they were rewarded over the last couple of years. International stocks have done very, very well. Bonds. Bonds look attractive today, particularly as a ballast to the portfolio, a hedge to potential stock volatility. Right now, the yields on bonds look relatively attractive, especially relative to where inflation is. And finally, real assets. It is entirely possible that inflation is going to be a lot higher going forward than it's been over the last 10 or 15 years. That's not a prediction. It's simply an acknowledgement of the possibility. We need to be prepared for it in our portfolios, and we can do that very effectively with real assets. With that, I'm going to wrap things up by just noting the importance of building a resilient portfolio. And resilience is really the result of diversification. If you have any questions about anything I said here today, please reach out to a member of your Baker Boyer team. We'd be happy to answer those questions. And I encourage you all to go watch the summary video of the economic updates, which will be released very shortly. So with that, thank you for joining me today, and good investing.